Today's video is going to be about our swing trade we call our downside move on the pound. I'll also show you kind of the reasons we were bullish the pound, and I'll also show you once we start to see that switch, we were, that's when we took more of a bearish pound outlook, shall we say. And of course, in regards to the dollar as well, we were bearish the dollar throughout all of this period here, naturally. So obviously that meant basically more upside for GU. And then we turned bearish officially around the end of July. And that's basically when we got into our short position. But first, to understand how we got into our short is to understand why we were bullish, and then is to then understand why we changed our bias. That's the important part here. It's not the reasons we are bearish the pound and bullish the dollar. It's now what did we change and what did we see before we, for the reasons to switch our bias from being long to being now massively short, right? Now, firstly, you have to understand is what drove this pound higher, what drove the dollar lower, etc. To understand that, you need to look further back. So let me just delete all of this. This is when I was all just teaching. To understand that, just look further back, right? And the reasons we also actually did sell this throughout all this period here, we did put all the reasoning onto our Telegram. So if you just go onto that, just type GBPUSD and just click the arrows up, you'll eventually get to the reasons why we were bearish it. And we sold it from this period here, and then we held it all the way down to the bottom. To understand going into 2023, the markets were heavily selling the pound, right? Because all of this issue here was Trustonomics, all of that absolute SHIT show in the UK. Gilt's obviously absolutely flying. And that was all massive reasons to be bearish the pound. There was so much pressure on that, unfunded tax cuts, where are they going to get the money from? And that just created more issues. The pound sold off. We then aggressively rebounded. Okay, and then we got towards the level. To be fair, that would have been an absolutely beautiful buy there. But we got towards this level here. Then we got into 2023. And the data in 2023 was actually not bad. It wasn't amazing. It wasn't something to go home and tell your parents about. But it wasn't terrible. And that was a reason why the markets were actually being long, because we went from such bearish urgencies to now the market's like, it's actually not as bad as we initially thought. And from then on, inflation was pretty strong. Wages were pretty good, or rising, of course. Higher wages tends to mean stickier or reinflation, which is a reason for the markets to maybe keep pricing into the curve. And then throughout this period here is when we start to see positioning being relatively stretched. Around that June-ish, right towards the end of that June-ish period, positioning was relatively stretched. The issue for me, right, is we saw this. So this one over here, we saw the curve, the Sonia curve. So we saw Sonia pricing 6.5%. 6.5%. Now, that's basically what the Sonia pricing stated where the Bank of England can get to is 6.5% interest rates. We were currently around 5.25% at that period. Can't remember off the top of my head. But we were nowhere near that. And 6.5% was what the markets priced. And that was a reason, though, why the pound actually rallied fairly aggressively all through this period. Now, that's a completely illogical way of thinking. Higher rates, especially from a pricing perspective, higher bond yields and higher rates tends to support a currency, especially the pound, right? Considering it's basically a financial instrument now, the UK, right? A lot of financial services go through the UK as a hub. So 6.5% was very attractive for investors, and that allowed the pound to also get that sort of FDI appeal, so foreign direct investment. People are seeing that, actually pricing in terms of bond yields and money markets were all pretty high for the UK, and that created some appeal for the pound, right? Remember, if you're going to invest into a UK asset or a company, you need to change your dollars to pounds. which basically tells you you're selling dollars, buying pounds with the GBPUSD upside. Obviously, us, we're small fish when compared to the massive institutions, right? But these massive players, these massive investors will be changing millions and millions and millions, which creates a fair amount of demand. And that cross-border moving from the dollar to the pound is creating upside for the currency. Now, I just want to quickly show us our outlook, so our mid-year outlook. So we made that around June-ish period. I think it's around the middle of June, 10th of June, something like that. And we put our reasons for the pound there. So let's just read through that, and we'll also show you when we saw that switch and why the markets went massively bearish the pound. So this is our mid-year update. We called it Fighting the Tide. That's because basically the markets were fighting essentially what the dollar was doing, and markets were fighting cutting expectations, basically. And now, in regards to the pound, this is what we stated here. So the pound has surprised the market with the rally that has had so far. We are coming into a conjunction now where the data may begin to slow due to the lagged effects of policy. We will take a more cautious approach with the pound since it has upside momentum in growth and risk sentiment, which points to the currency's strength, but could also quickly turn due to the lagged effects of policy and recession fears, which will cause some repricing down the line. That's what we saw in that Sonia curve, right? Sonia curve was at 6.5%. We saw that massive repricing. Those were all reasons to get bearish the pound. So we saw that happen. And that did come into fruition relatively nicely for the pound. For now, though, we will trade the pound versus others who are slowing or expect to slow soon and or has more headwinds. Apologies for any grammar mistakes here. I don't tend to proofread. We will likely continue to pair the pound against currencies while facing increased recession fears. But if we change our stance anytime soon, we'll obviously update you accordingly. Continue to monitor the data flow. So basically, continue to monitor the reasons you're bullish the pound, which is from good growth. Inflation was moving relatively high when compared to everybody else. Rates were moving higher. Bond yields are moving higher. These are all reasons to get bullish the pound, right? Inflation is stubbornly high in the UK. Doesn't show signs of significantly falling at a rate that the BOE would allow to hold. At the time of writing, the markets believe the Bank of England can hike rates by 108 basis points by year end. To us, this will cause more harm than good to the economy. As such, we feel that they will likely underdeliver on this expectation, allowing the markets to have room to reprice lower. This will be a headwind on the currency once that time comes. We did see that time come, and the markets basically, to understand when repricing is going to occur to either upside or downside, is to watch the data. So if the data tells you, and that's the data that the market cares about as well, and the data that the Bank of England cares about, once you saw that repricing occur, that's when it's opportunity to get short, because that's a massive reason you're bullish, right? Inflation's hot, wages hot, growth data relatively okay and relative to everybody else. Rates were moving higher, yields were moving higher. As such, thus all the reasons why we continue to see upside. And of course, we saw inflation upside, surprising at 8.7, expectation was 8.2, and this caused a huge repricing in the front end. So we saw that massive gilt 2-year yield push really hard. So obviously gilt 2-year bonds pushing lower, pushes yields higher. And recent pound moves seems to be determined by rate differentials. So obviously that's the spread between the 2-year gilt versus the 2-year US Treasury 2-year. So you're obviously looking at GBPUSD. If you're looking at Euro GBP, you'd have to look at the 2-year bond yield versus the 2-year gilt yield. That's to understand rate differentials. This is something a lot of institutions use very frequently in determining price targets. What channel is the currency trading through? And as you can see here, obviously this is inverted, but we saw that repricing occur here where higher spread allowed for moves higher in the currency. So obviously this is US 2-year versus the GBP 2-year. So that basically means any moves high we saw in this was GBP USD trading higher. And that allowed the currency to move relatively rapidly. Was also mentioning how the FDI component of the pound as well in regards to Northern Ireland Protocol. We also mentioned how the economic data in China and Europe began to slow, And this is a good scenario to see a currency appreciate since it's very risk sensitive to risk appetite. And of course, markets seem to be pricing the dollar higher as a result of that. So that was something for us to really monitor going forward. And then, of course, CFTC data or COT data, as people begin to talk about, that was relatively stretched. And that's why I was a little bit cautious on any more upside moves we were buying, because we don't want to be caught wrong-footed. However, we were buying the pound against the dollar, allowing the markets to be more optimistic on buying the pound, especially against the dollar when the time is right. And again, we were just monitoring that flow and saying, okay, we're still bullish GBPUSD, we're still bullish the pound. Why are we going to be bearish the pound? And then once we saw these reasons, we've literally told you here are reasons why we were bullish. We saw massive rates pricing in the front end. We saw inflation moving relatively rapidly. We saw rate differentials determining the currency. So to understand downside in the currency is to follow those rate differentials. So what drives rate differentials, especially the front end, is interest rate expectations, which was all of this. So if those interest rate expectations began to reprice because of data, that's reasons to get bearish the pound. And we saw that occur. Then, of course, we continue just to monitor the dollar flow because, as you know, throughout this year, up until basically the end of July, August time, we were massively bearish the dollar. So we were long GU, we were long euro dollar, and those are all massive reasons for those moves higher, right? Euro dollar peaking at around 112, 113-ish, GU around 131. And that's when, of course, we saw the data turn basically from the US from being bearish, markets having a bit more of a bearish urgency on the currency, to be now being bullish the dollar. Now, that's a double whammy. Now, as you can see how those are reasons. So it's important to understand the reasons you're bullish a currency, or at the moment we're bearish the pound. Why are we going to be bullish the pound? Well, the reasons we're bearish the pound needs to start to change before we have a more tactical outlook on the currency higher. Now, those are, again, reasons why we are bearish. So now let me just show you data we saw that turned for us to be bearish the pound. So as you just saw, I just showed you our mid-year outlook. We will be doing one relatively soon, actually, in just a bit of an overview of Q4 and kind of what to expect down the line. We do this for all of our currencies, most a G8, by the way. We don't trade NOK or Sweden, so technically we're not trading G10. However, enough rambling on. Why did we change our bullishness to bearishness? Now, in this period here, we saw GDP massively upside surprise in the US. So in regards to the GDP, so in the US, we went from negative 0.6 to a massive upside move in that growth rate. And this is all reasons why we needed to be changing our views. The markets were relatively pessimistic, the US, which is fair enough. The data wasn't exactly amazing in the US. That was reasons to be bearish the dollar, throughout 2023. We saw that massive switch around. Now, in regards to the UK, that was our main reason why we then switched our bias from bearish the dollar to bullish the dollar. So that's one reason for GBPUSD to trade to the downside. However, to trade it just one direction, for example, I'm trading GBPUSD because the dollar data is now turned up. That's more of a tactical play because we understand it's going to hit a level to a certain degree. And then if the US's data was only a little blip in the timeline, that would allow GBPUSD to trade higher. So you need a bit more of a... Doesn't mean you can't trade tactical plays. I trade tactical plays. But I understand that I may need to switch my bias relatively rapidly from tactically short to tactically long if I see something change. And then we went on to the UK. So go countries, then UK. The UK's data... So we saw a massive move lower in inflation all the way down through this period here. So in terms of core is what you need to really be focused on. Core inflation. July, August, September. Well, July was 6.9%, relatively good. Massive move to the downside in that data there. So that created more bearishness. Obviously, this was slightly later on. So as you can see, 6.2 came out in September. That was a reason in September to be bearish. However, if you really consider what the UK is services based. I think it's roughly around 75% services. So any services data is a reason to be bearish the pound. So what is services data? Well, Firstly, you have to look at PMI data. Services PMIs went from expansion to a contraction, a very large move to the downside in August. We saw that. And that was a big reason why we saw the pound sell off very aggressively. And that was us to like, ooh, okay, component behind PMIs, employment component, very weak. Prices were teetering. All the other components, mainly employment is what we focused on. That was a reason for us to be bearish the pound, because now if employment starts to fall, remember, PMI data is forward-looking indicators. It tells you what could be down the line. We saw employment component fall fairly rapidly. Therefore, we can imply that maybe down the line, inflation falls. This came out before that massive downside move in inflation. So this was gearing up basically for downside surprises in data. And from then on, the data just continued to point lower and lower and lower. And we saw this for GBPUSD. Throughout as well, you don't just look at the UK data, also look at the US. The US's data was really good still. And that was all reasons for the markets to continue to sell. So now that I had my bearish urgency, I do not buy against my bias, because if you're buying against your bias, you're buying against what the whole market wants to do. And then this is when you start to blame the so-called institutions taking you out, when in reality you are just trading the opposite direction all the time. So forget about your demand candles when you're selling. Do not look at them unless you're trading tactically, and that might be because of a sentiment shift or a data perspective. I do not buy when it hits demand candles. So like this one here, yes, it rallied out of this region here. I wouldn't have been looking at that for a buying opportunity, because I'm not buying it, I'm selling. So I'm only looking for sells. So what I did here was daily massive move to the downside. That was a market execution order. So there was no real technical reason for that. That was more of a fundamental reason at that stage. That was a market order. Sold it off until I got to around these regions here, where I then sold it again. So let me just do this. I then got to this region here. We then sold it again. So what I did, same technical strategy as I have taught prior. Go to the high time frame, find our order blocks. Now, let me just do this. Horizontal ray. Now, what I was doing in this period here was just marking out relatively key levels for both upside and downside. So obviously, we broke below that low there. So technically, I know some people like to call that a breaker structure. I don't know if you don't care if it's called change of character or whatever people want to call it nowadays. Breaker structure there, pulled back into a region. Now, my region was first this one here, but also a level down there as well. So what I was doing is like this. So my idea was, okay, anywhere within that area there is opportunity for me to trade out of, because we have some relatively key levels in there. We have 127 whole in that area. 127 looks to your right, and then 127.5 as another level for the markets to consider. You then have 127.750 from a order book stance. So that's key levels within that. Remember, just because I mark out a region doesn't mean that the moment it gets into that level, I'm just selling, because you're just guessing the top now at that stage, and guessing tops and bottoms is very, 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 very silly. So what I mean by that is, the moment it gets to there, you're just selling, because yes, you're bearish here, but you need technicals to work with your fundamentals, right? Technicals is a way of getting into a trade. It's not a way of determining where the trade can go, right? So, for example, here, we didn't see no major breaker structures until this period here. People would have been buying this up to the highs. People would have bought it here and try to trade it to the high. Buy it here, try to trade it to the high, because we're uptrending, when in reality, the fundamentals switch for the whole market to sell off. So this is why it's important to always follow your fundamental analysis, because it gives you an idea where the currency should be on a 3 to 6 month horizon. So you now know you have clarity to hold that position regardless of if it's pulling back or not. So we got into this level here and then sold off. I didn't manage to get into any other levels here because I didn't see big enough pullbacks. But you can kind of see where we was just trading from level to level to level to level to level. Here to the low here, broke the low here. We were then wicked out of this low here. This is why I said on the technical analysis video, please, it's the video just before this, the only technical analysis video you need to watch. that sometimes market conditions change and you need to alter your strategy slightly. And you can see here that my order block up there on that daily time frame, that my region, shall I say, didn't get hit. So as you can see, that 6 hour there, which was within that daily anyway, didn't get hit. So I knew I had to mark out some other regions as well. It's on the technical strategy, you can see it anyway, but it's there, and then it sold off. I then had a market execution once I saw a 2 candle swing out of my level, which was around here. 2 candle swing entry. Again, I know some people in the technical video wanted that 2 candle swing, so we can do that for you, no problem. And then all you do now is we'll break some lows here, lows here, lows here. Wait for the pullback. If you missed it, do not worry. There are more opportunities to get in. Now, for this level here, it looks like it just missed it. It's okay. I'm not looking to probably enter again. I'm pretty exposed to sales on GU anyway. But we entered off this, or the markets bought up on 127.50. Again, orders came in previously at 150. Level after that was 127.50. Sold up, bought up from here. Market function was, of course, GDP came out hot, buying a rumor, selling the fact. Bought up. Markets are still bullish the dollar, still bearish the pound. So any moves higher we see, this is just a reaction function. We've made a video on that for members anyway, but this is a reaction function. We saw that move higher, and now we're looking to sell. Where are we looking to sell? Well, if we go on the daily, as you've learned in the video before this, the technical analysis video, how targets are set at institutions are very simple. All you're doing is you look to your left and look at lows because you're selling. Remember, lows because you're selling. If you're buying, you're aiming for highs. So because you're selling, you aim for a low. Well, that was 120 level there. Nice big whole numbers, remember, psychological levels. Then 118 is the one after that. And I've seen some people continue to suggest 118 is doable on the next sort of 3 months. I believe Goldman Sachs actually expects 118 for GBPUSD. Now, let me just actually show you their reasonings for that. So this is Goldman's FX stock they do weekly. And this is what they state here as bearish necessities. I've put this screenshot into the Telegram anyway. You're more than welcome to look at that. But as you can see here, they are bearish it based on the Table Mountain effect of policy by the MPC. So Table Mountain, what they're referring to there is obviously in Cape Town, where it's very flat. So holding rates to policy, holding levels for longer. Noted that he is reasonably confident that rates are in fact restrictive. And 3, cautioned on the risk of putting too much weight on late cycle indicators such as wage growth. While the next few weeks may see more range-bound performance in the relative global growth picture, looks more balanced, and the Fed leans into its wait-and-see stance. For now, we would likely need to see bigger shift from the Bank of England or the Fed to change our bearish view. Again, they need regions to change their views. Therefore, we expect GBPUSD to grind lower towards our 3-month forecast of 118. And this is what they mean by asymmetrically responsive to data. So that's an important consideration for the pound. But yeah, that's their views. You're more than welcome to pause it and read through that. This was on last week. So obviously I'm recording this on 26th of October. This was last Friday's document. So it's up to date basically. But yeah, overall, the markets are still bearish the pound, and so are we. And as a result of that, we expect GBPUSD to fall toward our target of 120 and then 118 after that. Hopefully you've learned something today, and we'll see you in the next one. Take care.